2022. After a year like 2021, what in the world should we expect? Well, the RLS boys dust off the old crystal ball and discuss projected economic growth, inflation, interest rate hikes, supply chain pressures, labor constraints, and the possible continued impacts of COVID-19. We then ask how the high unfavorability ratings of both the White House and the Congress, coupled with the prospect of a drubbing in this year's midterm elections, might stymie or, for that matter, accelerate Democrats' policy goals for new taxes and massive new entitlement programs. Finally, in light of all this, we consider what all this might mean for the stock, bond, and commodities markets, along with possible ways you could position your portfolio accordingly. Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Erik Olson. Adrian is not with us today as well. He is traveling a day early to avoid getting stuck in Maine. So he's on the road somewhere right now. Adrian, I hope you're driving safe.
Yeah, I wonder, do you kind of wonder if this is just a ruse and just Adrian is just trying to see if we can survive a podcast a couple of times in a row without his assistance?
Is this a holdout on his contract?
Right.
Yeah, I actually think he'd rather be recording than driving. I think it's like a 14-hour drive, something very long for him as far as the drive goes.
Well, this is, but nonetheless, here, look, once again, Roshan, second time in some years that you and I are trying to carry this on our own. So let's see how this goes.
Yeah, and you know what? Maybe he just wanted to not be a part of your series concept that you've been pushing for years. So
Yes,
last week we did the year in review. Now we'll talk about the preview for 2022, and we'll go over different areas and then what you as an investor can look at and what you can do about it. So, Erik, let's start us off. You had a great framework.
Well, so yeah, today I thought, folks, we would talk about both economy and markets, and then some of the implications of what we're going to say in observations about the markets. Then what sorts of action steps might that imply, and adjustments in either your approach or the composition of your portfolio. I do want to say, though, that forecasting or giving a projection like this, giving out an outlook, is a very messy business. It's one thing to say, hey, here's what actually happened. It's a completely different thing to say what might happen. In fact, I went to, there's a group called Focus Economics that has a list every year where they rank the accuracy in the prior year of various private sector forecasting groups on a variety of measures. Those would be, inflation, GDP growth, interest rates, and so forth. And they do that for pretty much every active, measurable economy on the planet. But here in the United States, I went back and I looked all the way back for the top three forecasters for 2020, all the way back to 2015. And what I found was that there was, in the top three forecasters, there was only one company that showed up even twice in the top three. In other words, there's not a lot of consistency. It seems, to a large extent, it's just kind of luck of the draw if you wound up having the most accurate projection. And so on that basis, there are a number of forecasting groups that said, hey, rather than try and nail it, let's just use a consensus forecast. So there's the consensus forecast on a subscription basis from Focus Economics and from the Blue Chip Indicator Group and so forth. And so we're just going to talk about, in general terms, what sort of broad projections are about some of these numbers. And, we'll see a year from now if we were roughly correct. How about you, Roshan?
Yeah, so first, a great way to start it off, I would say for myself, the way I look at this and for everyone listening, one is the forecasters aren't going to get it all right. Where I find it useful is general direction as opposed to accuracy of their information down to the second decimal point or anything like that. So that's where I think we can look at general themes, but I would bet that all the sources we're going to cite and review will be wrong on something to a certain degree. But I think the general theme of what's going on with the markets, we can use that to help us get some direction and to help us look at ways to invest.
Absolutely. So let's just start by talking about projections about the economy. What are you, Roshan? What were some of the things that you observed in terms of your review of the projections out there about what to expect on the economy side first, and then we can come to the markets?
A return to more normal growth rates. This year looks like we're gonna close, and by growth rates, I'm sorry, I'm referring to GDP growth. This year we're looking at it hitting around 5% is what we should close the year at. And they're saying we'll get back to the expectations to get back to normal levels of 3.3%. Going back to what I said about general direction and the guide, to me, that makes sense. There was pent up spending out there. Also, supply chain issues, which are causing people to bid up some products price wise. So you've got a few things that are causing the number to go up that I think will normalize. So I think getting back to a normal GDP makes sense to me. What are your thoughts on that?
Yeah, I agree with that number. Most of the forecasts I saw were sort of projecting high twos to high twos to mid threes, sort of settling in there in the low threes, like you said, 3.3. That sounds about right. So yeah, so that was one. And then in terms of inflation, what are you seeing about inflation? Obviously, we are ending here, I think the fourth quarter, or at least the November number. I don't know that we have the December number. I think the year-on-year CPI growth from November of last year to November of this was 6.8%. And remember, that's blending some of the highs and some of the lows. So, food inflation and other things like that, and energy inflation, even more so. So, what were you seeing about forecasts for inflation?
Yeah, so I'm seeing also getting back to normal for inflation. Interesting notes. I just like picking out these dates sometimes, but highest inflation rate since '82. Is what we've got. What'll be interesting to me on this is the argument that's been happening since inflation has been a major topic, which to me was probably late quarter one, quarter two of 2020. Is it temporary, or is it supply chain driven, or is it more permanent inflation? And we should have answers to that soon. The one thing I believe you have on your list as an overall category that I'm sort of getting us over to right now as well is just COVID, but that's going to be a driver, right? If you've got supply chain issues because there aren't enough people to work, like we saw that with lumber earlier this year, there weren't enough people to work the mills. Semiconductors we've talked about at length. So I'm hoping we get some clarity on inflation versus supply chain, and COVID will be part of the answer there. If we're able to continue working normally with any new variants, things like that, I think we'll be fine. Although interestingly, I wish I could remember where. I have to look this up, but I had heard that some schools locally are going to go back to virtual. I heard that from my nephew, and sometimes his information is not accurate. So I'm quoting my source, and he doesn't listen. So if he does, I did say your information is not always accurate. But so that's my nephew Sage told me that, but I need to look that up. I'm hoping that's not the case, just because not even from a major economic or outlook forecast. One, I'd be pretty surprised because everything I'm hearing about the variant, the Omicron variant, is that it's not as severe. It doesn't last as long, although it is more contagious. So I've also seen a few things that said this may be signaling more towards. This may be an early sign that we're getting towards the end of it because it's more mild. So I'm hoping all that's true. But if Maryland schools are closing, I'm just hoping that's not a trend. I'm going to look that up.
Well, so you tied a few things together there. So let me just go back to the beginning of that sequence of ideas and just talk in terms of wrapping up the inflation. And then I do want to talk with you about the
Yeah.
impact on supply chain and labor. But on the inflation side, we had done an inflation episode much earlier in 2021, and in that, I know we weren't all in complete uniform agreement about everything, but I was saying that I believed that this was indeed not a permanent elevated inflation, that we would, over the coming 5 years, probably be higher than the low twos or high ones that we'd been enjoying for a while. I thought we'd settle in maybe in the high twos or in the low threes, somewhere in there. And I still believe that's correct, but I also think it's going to take a while until we resolve all of that. So first half of 2022, I'm expecting still elevated inflation, maybe in the 5-6 area, 4-5-6 area, somewhere in there. And then only then, if we, as you pointed out, we can get past some of the supply chain constraints and labor shortages, do we then reach a point where we settle in? So I want to come back to those two topics, but let's talk about COVID. Since
Hold on.
Mm-hmm.
Well, just add on the inflation, unless you've got more on there. There's one other point. One, I believe you mentioned this, but we are, as of November, we're almost at 7%, and the Fed mandate is to try to keep us around 2. So if you if you look at those two numbers, that's 3.5 times an annual number, right? So not arguing if it's temporary or permanent right now, just the numbers themselves.
To appreciate how elevated. Yes.
Yeah,
absolutely.
exactly. You've got it. 3.5 times higher almost, and then going a little bit further, I'm seeing similar things to what you are in my research, that it looks like it'll be higher in the first half and then settle down to around 3. But even 3 is 1.5 times that Fed target. Now, inflation is better than deflation, as I've mentioned Helicopter Ben, that nickname, on multiple episodes in the past. But still, 3 doesn't sound that high, because it'll be lower than almost 7. But at the same time, it's still 1.5 times what we're actually looking for, at least what the Fed's actually looking for.
Okay, so I'm glad you brought us back to this, because I think maybe it's also useful to say so. But what could change our forecasts, or what would cause us to see something other than what would lead us to believe that our original forecast or our core forecast are likely to be modified? I would say you pointed out one thing is COVID, and I'm going to come back to that. Another thing I would say is, if we have two things actually. One, if it settles into people's mindset that there is now elevated inflation, it has a sort of self-reinforcing quality to it, in that employers start giving cost of living adjustment raises, not just performance raises or that sort of thing. And once that starts to take hold, and then workers expect that, now you have everybody sort of playing, so it becomes, to a certain extent, a self-fulfilling prophecy. That's number one. Your thoughts about that?
I can see that as well, to a certain degree. I just feel like at some point, maybe that could take us from 2 to 3. I don't see that taking us from 2 to 7, though. Right?
No, not 7.
Yeah,
but 4, 5.
Maybe. I would not like that, because I'm thinking of it going back. We're going across our different topics right now, but I'm thinking about from a market perspective, and that would not. I'm then seeing Fed raising rates, even faster than they planned. So I'm hoping that that's not the case. That it's creating a self-fulfilling prophecy. I have to look up the numbers on the wage gap, but just going back, the long-term data on that says that wages have not been rising as they should, to stay in line with inflation over the last 20, 30 years. That's the argument, that corporations are keeping the profits for themselves and not passing it on to employees. And we've seen data behind that. So even if that self-fulfilling prophecy holds true, I don't see that turning a long-term trend in just a couple years.
I hope you're right. I just think back to the 70s And once the inflation mindset started to take hold, it started manifesting itself in negotiations of all kinds around pricing and so forth. So, but I certainly hope you're right. Here's the other thing that I think could affect this, and you can pick whose story you think you find most plausible, but even someone who hardly can be no hardly could be characterized as a right winger, Larry Summers has said that the extent of federal spending, as well as Federal Reserve bond purchasing, or asset purchasing, but especially federal spending, has been overdone. And as a result, that has added fuel to the fire and driven prices higher. So in his caution, he's cautioned policymakers about going further with that, as would have happened, for example, with Build Back Better, had that gargantuan proposal been passed. I mean, we again, just to recap something we've said before, it was pitched as 1.9 trillion or 1.75 trillion, or in its slimmed down version 1.5. But that was, many programs in there were then officially scheduled to end after 1 year. Is that going to happen? No, that is not going to happen. So when the Congressional Budget Office scored it and looked at it with the assumption that those programs continue to be funded, they're saying it's a $5 trillion spend over the coming decade. So with that, you start to say, okay, how do we prevent these things kicking in and further reinforcing this inflation?
Well, and you talk about that, and we're not. That's still not done, right? Like there's still the talk about increased taxes targeting the wealthy and corporations, and if you change corporate taxes, you increase corporate taxes, you're lowering earnings, which is another downward pressure on the markets, and arguably less money available then to pass on to employees, which would then lead to pressure pushing inflation down.
That's possible.
I mean, it's. I'm not pro corporate tax. I'm looking at this for how can my clients grow their wealth, and higher taxes don't help them do that. We're just not out of the woods with all this spending. It's still, when we were talking about things that could change what's expected, there's another, in addition to, we mentioned COVID, another thing is just Build Back Better, that how that continues to be negotiated and what's next.
Well, you've made a good distinction there. So it's, on the one hand, there's the spending side, which would fuel it. There's the tax policy side that could tamp it down. So I fully agree with that. And actually, that really just leads us into not only policy but politics, I think. And so if you look at, if right now the favorability ratings for the White House, both the president and the vice president, as well as Democrats in Congress, were just running really, really strong, I think you'd see a higher likelihood of some of these measures being passed. Right now, that's not the case. And that, I'm not saying it can't change, and in fact, it has changed since November. There's been a rebound, not a big one, but at least the signs of a rebound in approval ratings or job favorability ratings toward the president and vice president, as well as the Democrats in Congress. But that, who knows where that's going? And if, as you come into the midterms, you find, generally speaking, that policymakers get more and more cautious because they don't want voters who have admittedly short memories, they don't want them at the ballot box sort of taking it out on those politicians. So I think it's going to be even harder in 2022 than it was in 2021 to get some of these measures passed. Would you agree with that?
It makes sense at the very least for the first 11 months of the year, right? Yeah, until we get through those elections. Yeah, I that makes a lot of sense. It will be harder to get something like that through. Does that then, going back to how we went down this path, which was government spending and inflation, would you then, in your mind, think that's a less of a risk because the likelihood of something passing it seems lower?
Possibly. So the offsetting, possibly, but the offsetting component of this, which I haven't really said, is that despite the understandable fear, particularly of moderates in sort of purple districts, to be cautious about what they get their name tied to, there are actually some people who are comfortably situated in either full red or full blue districts who don't have to really adhere to or heed those kinds of don't have to be quite as cautious. And it is interesting that Nancy Pelosi in particular, as the Speaker of the House, drove moderates into a very difficult position by pushing and pushing on some of these bills. And if she does the same thing in 2022 and says, "Look, we may have some losses, but this is our one best last chance before potentially control of the House and possibly the Senate shifts following the 2022 elections," we have got to do it done. We've got to get it done now, or it's not going to happen. And so it might be that my essential expectation of a reduced chance might be sort of countered with a furious push to get some of these things through. I don't know.
Yeah, you know what I wonder about what you just indicated is just the fact that the way the split currently is,
Mm-hmm.
you only need one person worried about their job to not vote in the direction with you,
Well, in the
right?
Senate for sure,
Yeah.
yes.
So
Where it's 50-50, yeah, absolutely.
so I think the that counters that argument to me, the fact that you only need one person thinking, "Hey, I can't vote for this because I have career risk if I do, and I won't get reelected," whereas versus needing everyone to feel comfortable putting that vote in. But
Mhm.
yeah,
Mhm.
I don't know. Once again, I'm hopeful that that they're not able to increase taxes. So I like your first theory better than your second.
All right. So back to then the supply chain question and COVID and labor shortages and so forth. So you talked about COVID. We've been hearing until yesterday, I believe it was, that wow, overwhelmingly the number of cases that are of COVID-19 that are now being new cases are identified with Omicron as
Yep.
opposed to Delta. And just as a recap, I think most of our listeners are pretty attentive to these sorts of things, but Delta was somewhere in the neighborhood of 40 times more transmissible than the original Alpha. I guess it was the Alpha variant. And Omicron is, I believe, I've heard 70 times more transmissible than Delta. So if you put those two, you do the math on those two things, if those numbers are correct, then Omicron is 2,800 times more transmissible than Alpha was. So, but yesterday it came out, and folks were recording this on December 29th. So yesterday it came out that that was a mistake, and instead of it being a majority of cases that are surfacing, and at least in the hospitals right now, it seems like it's only around a quarter of the cases so far, at least, that are Omicron related. So it could be that Omicron isn't quite as transmissible, or it hasn't spread quite as widely yet. But if your thesis is correct, that the severity of Omicron is much lower, then absolutely I mean, I'm not saying I'm eager for anyone to have COVID-19, but thinking of it at a global population level, if everyone could get the sniffles and then we could all get this behind us, of course, I'm
Yeah.
folks, I'm explaining that in the most, sort of casual way. There will be some people whose lives will be ended by this. I understand that. But my point is that if we can reach that stage, what a breakthrough that would be, to the positive side of finally creating an immunity level in people that puts this to rest for now.
Yeah, and when you talk about the percentages, so I just Googled it just because I'd heard different numbers,
Mm-hmm.
and literally the first one, every article I see has a different number, all within
Oh,
a few days date. So that just makes me wonder, where they're getting their data from. So NBC News on December 20th says 70%, 73% of new
Right.
cases
Uh-huh.
are Omicron. Then you've got New York Times 8 hours ago says 59%. Washington Post 18 hours ago 58.6. So that's about the same. 4 hours ago, ABC News has, that's not this one. December 20th, another one says 73%. Now we're a week later, but
Uh-huh.
it's just where are the numbers coming
I
from
thought it
just
was
because they're so
CDC
different.
yesterday said 23%, but
CDC
growing.
said 23.
I thought so. I could be wrong. I'll just put an asterisk on that, listeners. But and of course, by the time our listeners hear this, it's going to be early January, and as a result, the numbers could be very, very different
again.
But the principle of hoping for some dramatically, it would be just such a blessing to have a substantially reduced severity in a variant come through and essentially provide people with immunity that doesn't, throw them into the hospital or on a ventilator or but kill them.
Yeah, Eric, I wasn't questioning your source. I was just questioning where everyone's getting it from because they're just the numbers are just so different. And I found one that has some clarity, which is they're using not just U.S. statistics. That's where you're getting, NBC News 14 minutes ago, 61.5%, whereas New York Times 8 hours ago, 59%. Either way, I'm just throwing all these numbers out there, just saying. Now I'm just questioning where the data's coming from. I can tell you something.
Sure.
Yeah, anecdotally. I had mentioned that I was in for a family member in the ER. I mentioned this to Eric before he started recording on Monday, and they had a line out the door. They had all the rooms filled, and along all the hallways, they had patients. And there were people there saying, I've worked here for 20 years and I've never seen it this busy. I did ask them if it had to do with COVID, and there was someone that they were just guessing that had been working their full shift, that it said about 25% of it that was COVID related. So I just either I went on the worst day in all this time frame, but you take that 21% out, and then maybe you don't have all the hallways lined with beds.
Sure.
And so it's just really, really busy right now out there. I'm not sure what it is, but this actually, all of our discussion on COVID, the data, what I've seen anecdotally, what we've all read, sort of underscores the potential impact of this. It's just that, just like when it started, nobody knows, but that could throw a wrench into all these forecasts.
Yes, that's true. So let's come back to the economic consequences of this, because depending on the direction, we were talking about the supply chain shortage, and that's certainly one. I believe, I think most people have carried the assumption that, well, okay, if people then don't have quite the same level of concern about contracting COVID-19, that they'll return to work and things will stabilize, and this will ease supply chain and logistics. Well, I would say there's two possible counter arguments to that thesis, and they connect to the labor supply question. So some of my clients are in logistics and at a fairly senior level, and in human resources at a fairly senior level. They're not projecting that what we're facing right now is going to be resolved by this essentially the ebbing away of the COVID concern. I think what they're saying is that this pandemic, now becoming something I guess we'll say is endemic, has shifted, coupled with this incredible growth in many people's personal balance sheets, has led a lot of older workers to say, you know what, I don't need this anymore. And they've stepped out of the workforce and are not coming back. And as a result, until there are skillful people to replace them, skillful people, not just people, but skillful people to replace them, then these companies, in order to function, are going to have to work with the new normal of extremely constrained labor. And as a result, are going to be looking for other ways of getting business done that are not so labor intensive. So I think that's pretty interesting. It seems to me. Your thoughts about that?
Well, I mean, to me, that's a long-term trend of lower or less jobs. about a year ago had a conversation about some of this, and I think we talked about how some restaurants now you can order from your table, right? You do the QR code,
Mm-hmm.
the menu comes up via the QR code. You can also order,
Mm-hmm.
which leads to less staff. And then we also discussed how, like at McDonald's, they have these huge touch screens now where you click through to order what you want. Once again, leading to less staff. And the argument
Mm-hmm.
is, well, then you are creating jobs because you need people to repair and maintain and manage these things,
Mm-hmm.
but
Mm-hmm.
you're also losing a certain amount of jobs. So then that would be a pressure on employees to either get more skilled or be out of a job, which
Mm-hmm.
then on a greater level, you're thinking about the long-term economic impacts of it, which would be employment, although employment numbers are looking pretty good right now. So we're probably talking years down the road having an impact versus next year.
Yeah, employment numbers. By that you mean the relatively low unemployment, and
Correct.
yeah, so it's a little bit contradictory. So the unemployment rate is pretty low. The labor participation rate, though, is not as high as it was.
It used to be. Yeah.
So you have working age adults who have decided for whatever reasons that they're not going to be part of it any longer, and as a result, when the available labor pool is measured, then it produces those relatively lower unemployment rates. Here's another consideration on the supply chain forecast, and that is, irrespective of the labor question, some of the companies that have been just trying to kind of make their way through this and sort of struggling and struggling and struggling, have in some cases taken on debt to try to keep the doors open. And the question is will they, particularly if the Fed starts to raise interest rates and their borrowing has any sort of floating interest rate quality to it, will they then find themselves under such pressure from the debt load before the revenues start to flow again that they simply can't continue?
Yeah. Yeah, and I don't know that this was a debt related at all, but or pure pandemic, but there are multiple local businesses I've seen that aren't open anymore, right?
Mm-hmm.
Through the pandemic, which like one of our favorite places to order pizza from is it doesn't exist anymore.
Mm-hmm.
Right. So
Mm-hmm.
you do have that closing
Mm-hmm.
of businesses, although I wonder like to that labor force, what happens, right? What happened to the people that were employed there,
Mm-hmm.
or in general, where are they going to go to get a job? And maybe there's part of your labor participation rate. You've also got, I don't have the data to prove this, but I remember a popular point in the summertime was the additional unemployment goes away in September, so you'll start seeing some of the labor shortages disappear. We're now in December, and that doesn't seem to be the case,
Mm-hmm.
right? The
Yeah.
data's not proving that, correct?
Mm-hmm. Mm-hmm. Well, there's a lot of things that are dynamics that have been sort of parallel dynamics to this. How I wouldn't say are necessarily COVID related, and then some that are specifically COVID related. One I'll just mention that I think is more parallel than caused is young men and the participation of young men. By that I mean people between, let's say, age 18 and 35, as the extent to which there are a number of what percentage of that cohort has dropped out of the labor force is surprising. I think the number I saw in a report last week is that it's somewhere in the mid-teens. And
Wow.
in fact, the number of young men in particular who are living with their parents also until age 35 is at least the cutoff point where this was measured, is also has substantially increased. So um, this is not in any way, listeners, particular our female listeners. This is not in any way. It's sort of a wish for. I want everyone to thrive, but I think part of what includes everyone thriving is helping young men re-engage and feel the compulsion to actually be in the workforce rather than looking at it quite as optionally. I think it harmful to their financial well-being as well as their character, to family formation, et cetera, et cetera.
So I am just thinking through why. Like when you first tell me
Mm-hmm.
young men are lowered in the workforce, I'm thinking, well, how are they supporting themselves? And you answer that by saying, well, they're living at home
Mm-hmm.
with their parents. So
Mm-hmm.
that's got to be part of the reason. I don't I didn't look into the data as deep as you did, so I
Mm-hmm.
didn't see that in particular. But I agree that something's got to be done with
Mm-hmm.
it. Just thinking about the longer term, greater implications on society, right? If we
Mm-hmm.
lose just a huge chunk of the workforce, and you've also got population growth, not as it was, generation ago.
Mm-hmm.
So that we will have we'll have to find employees
Mm-hmm.
from somewhere as a
Mm-hmm.
country overall, and if we don't, um, then opportunities will just disappear, and people won't want to move here into the
Mm-hmm.
United States in general as much as they used to.
I think there's a lot of truth to that. So, I'll mention a couple other things, and that is just in terms of travel and leisure. So, I think people are noticing, all these flights shutting down because of flight crews aren't able to make it, and certainly I think that's feels more like a wave than a long-term trend. But it's amazing. You thought you were starting to see some progress on those fronts, and now you're seeing in the wave of these explosive numbers of cases, new cases, constraints being reimposed. I think, what is it? Was it in the city of? Was it in Philadelphia? I think. Um, they're now imposing new kinds of mandates on people that had been sort of dropped away. I live in Michigan, but I have a lot of clients and I have an office in Northern Illinois. And there too, boy, the constraints on where you go and what you do and how you gather and masks and so forth are a lot more severe there than they are here. And maybe that's going to continue. You're going to continue to see that sort of tightening. So I'm just concerned about those sorts of sectors of the economy that rely on that if they're going to go through another difficult phase, so that more of the pizza shops in your neighborhood will be closed a year from now.
Yeah, I keep saying I hope not on this, right? We don't know for sure with
Mm-hmm.
what's going on, and I'm sure everyone hopes not and hope that's not
Mm-hmm.
the case. But
Mm-hmm.
um, yeah, that's as we said, a couple potential things that could throw off all these four, which is why all these
Mm-hmm.
four. I'm not surprised that you only found three companies that were even in there multiple times.
Mm-hmm.
I wouldn't have been shocked if it was no companies on there
Mm-hmm.
multiple
Mm-hmm.
times, just because there's so much that can happen that's just unpredictable
Yeah.
in any year.
Yeah. Well, why don't we switch over and talk about markets now? Because we've talked about
Yes.
the economy. So, what are your outlooks on the markets? And we're talking about markets plural. So we're talking about stock markets, bond markets, commodity markets, U.S. markets, international markets. What were some of your observations about that?
Well, bonds are a dangerous place to be with the Fed taper slowing down as well as expected rate hikes. What I've seen as far as that goes is expect the taper to be completed right around March, and then expect rate hikes to start in the fall with three of them anticipated, three quarter point hikes.
Hmm.
And as we discussed, how things could change. Fed policy is another thing that they've done a pretty good job since 2009 when they said they wanted to be transparent. They did a pretty
Hmm.
good job saying what they're going to do and then executing on it. But there
Hmm.
are occasions where they have to change course. I think it was in December of 2015 they had a hike and they were planning to do a couple more and they had to just because of changes in the economy. It was China back then that caused some overall economic changes. That can happen again. Are you
Hmm.
seeing similar expectations from the Fed, first of all?
Yes, in fact, it's not. Sometimes you see a divergence in what the Fed is saying they're going to do and what the markets, as reflected in the pricing of bonds within the private sector, what they suggest that the market has as a consensus the Fed will actually do. But in this point, they're indeed in agreement that the Fed will probably raise three times then in 2022, and another three quarter point rise increases in 2023. Now,
Yep.
I know that sounds wow, that's a lot of raising, But put that in context. That's you're talking about even if they did all six at a quarter point, you're talking about 1.5% higher interest rates at the end of that process over a 2-year period. That's not, I would say, a crushing blow. And in fact, for those of our clients that are relying on fixed income, that actually might be attractive because then they can look forward to a point in time where they're getting something more for their bonds, even if in historic perspective, it's still relatively meager. And from those that are, instead of relying on the income from bonds, instead those that are borrowing, even a 1.5% percentage point increase in, let's say, what it costs to borrow to buy a home isn't, I wouldn't call it devastating. It's certainly going to, I think, put a little bit of a damper on what kind of prices people can afford to pay for a home. And so it might tamp down a little bit the rapid pace of growth in home prices. But I don't think it puts businesses in a position where they're saying, well, then I just am not going to be able to borrow. We can't undertake our expansion plans, et cetera, et cetera. Your thoughts about that?
Completely agree with you. And we talked about spending, and we've talked in the past a lot about modern economic theory. At least we've touched on it. The Fed has to raise rates, right? They have to raise rates in preparation of what the next issue is economically. And I'm not even talking about, hopefully there's nothing major like COVID, but even if it's just, even if the market hits or the economy has a recession at some point, they need to have some options on what they can do, right? And this whole bond buying, that only goes back to 2009, right? And then if you go to when they included corporate bond buying, even a shorter history. So they were coming up with ideas, right? They were coming up with the new ideas because they had already driven the rates down so much. So hopefully we can get back to a more normal time economically. And so I feel like they have to raise rates at some point. I mentioned how bonds are a dangerous place just because as rates go up, prices go down. So you've got to be careful there. At the same time, a lot of what I'm seeing with the markets and makes sense to me is that the markets aren't going to have as high an increase next year as this year. I'm seeing things more in the high single digits expectation wise. What are you seeing, Eric? And when I say the markets, I'm talking about the equity, the S&P 500 in particular.
Right, same sort of number. I think I'm seeing somewhere in the mid sixes is a reasonable expectation. Now, listeners, let's put this in context. So historically, the total return on the S&P 500 might be somewhere in the neighborhood of an 8 or a 9. Well, that's including dividends. And dividends used to be a lot higher back, 2 generations ago, back in the early 1900s. Dividends were a substantial part of that total return. Let's say maybe 6% was a kind of typical dividend payout. Mid 20th century, it subsided somewhat, and it went to about 4. Late 20th century and early 21st century, it's been about 2. And by the way, that in part was a byproduct of a rule change made in late 1982 that allowed companies to return those dividend payments to their shareholders, not in the form of actual dividend payouts, but instead appropriating those dividends to internally repurchase the stock of the company, shrinking the number of available shares and implicitly causing the price then of those shares to rise, since the market capitalization of the company, all else being equal, was now being divided over a smaller number of shares. But today, the dividend forecast, incidentally, is now up for the S&P 500 at least, is 1.3%. So it's really gotten to be more and more wafer thin, I would say, on the dividend side. And so the majority of that total return now will be, essentially what's taking place on price. I think what's interesting on that level, though, is to understand what drives price. And it's 2 primary things. One is earnings growth, and that's the most important thing. And forecasts I'm seeing for earnings growth for the S&P 500 are 9%. So you might be saying, well, if it's 9% forecast earnings growth, but only, let's say, mid to high single digits, less than that, let's call it less than that in terms of the total return on the S&P 500, what accounts for the difference? And that second part is known as the expansion or contraction of the multiple that people are willing to pay for earnings. And in a rising interest rate environment, the math of it, what we call discounting future cash flows, the higher the interest rate, the more that future cash flows are discounted back into present value terms. Hence, the multiple contracts oftentimes, all else being equal, it contracts in the face of higher interest rates. So multiple contraction coupled with those earnings gives us this projection of a mid to high single digit number.
That's a great explanation as you started it. I was thinking about that. I was hoping you were going that direction, talking about the PE multiple as well. So that's a good one. And you talked about the yield on the S&P being low. That being said, you're getting a better yield in stocks than you're getting in bonds, right?
Right.
So if you're, and that's the Fed's plan in many cases when they cut rates is you're going to go into theoretically riskier assets, right? So as rates go up, people will have less of an appetite for risk, so they pull it out of stocks, and that's where you get the multiple contraction as well. So, so yeah, that I think is a very important point for next year as to why you would have lower than expected or lower than this year in terms of market returns. Now, there are a couple firms out there as well that are saying they expect a decline. Like the consensus is is single digits, and it's not that rare to see firms expecting a decline as well. But would you, if you had to decide your expectation, right? Do you think the odds are higher of another 20+% year, or of a negative low number, right? I'm trying to pose this question.
Negative or
right?
low? I'm going to say negative or low. So the S&P 500 right now, I think, is, if I'm not mistaken, it's about 48.65, something like that. And somewhere in that neighborhood. I'm not looking at it. I haven't looked at it today, but the somewhere in that neighborhood. So what are the forecasts? I've seen, and maybe you tell me if you've seen comparable forecasts. I've seen forecasts for the S&P 500 ending 2022 somewhere between 4,400 and about 56, 55, somewhere in there. If you pick
similar numbers,
is that right?
Yeah.
So if you picked sort of the midpoint of those and you went to let's say 5,000, 5,050, 5,000, 5,100, somewhere in there. That's kind of in between that range. That's where you get that 5 or 6, possibly 7% return from where we are right now. Let's call it 5-ish, 6-ish, somewhere like that. Do you see it differently?
No, I see it the same. I just ran the math on it, but that low of 4,400, that'd be from where it is right now about an 8% loss. Right, so that's our extreme low, and the extreme high you saw was in the 5,500 neighborhood. Was that correct?
Yep, somewhere in there.
Yeah, actually, I'm looking at it right now, and on this list I'm looking at, it says 52. So I'll use that number,
sure.
5,200. That would lead to an 8% positive. So if we're looking at that range, right, it's actually fairly tighter than we've seen the last couple of years, right? From a +8 to a -8.
Well, and again, those are sort of their midpoint forecasts. That we're not saying it couldn't get higher or much higher, and we're also not saying it couldn't get lower or much lower. I mean, anything can happen, I would say, but at least in terms of setting expectations broadly, you can see it's a fair, as you pointed out, a fairly tight convergence around a set of numbers, and it doesn't look like there's much movement. Put that in context, because over the last 3 years, 2019, 2020, and 2021, the S&P 500 has been up roughly, this is again total return, about 31.5% in 2019, 18, I think, or something, 17, 18, if I recall correctly. Maybe it was 19 in 2020. And then so far this year, somewhere in the 29-ish area with a few days to go. So those are big gains compared to the forecast. Well, big in any case. Those are just big in historical perspective, especially 3 in a row like that. But now when you say, okay, what's ahead? It's more subdued. And if you look out 10 years, oh my goodness, we have been saying this for so many years. And so because we've been just reporting to, to our clients and now to you, our listeners, the forecast returns to the various asset classes that most people will include in their portfolios are so subdued. And Roshan and I actually were having a conversation about this just before we hit record today, because it's on the one hand, you don't want to be dismissive of entirely, at least, of those forecasts, but you also have to acknowledge there's been a long period where it's been very subdued forecasts that have just not been even remotely close to what's actually happening. And you're wondering, okay, how are the models so far off from what then actually subsequently unfolds? My answer to that, Roshan, is the Fed is the wild card, and the Fed, with this incredible quantitative easing process since 2009, has led to unnaturally high asset levels. But I recognize that's also not the sole explanation. How do you reconcile those two things?
Yeah, I was going to say the Fed, and I mentioned this on our last episode, and I really wish I could cite the source, but around 2011, 2012, one of these famous money managers came out and said, Fed low interest rates and stimulus is here forever. And he had a whole case as to why it can't go away. And I remember thinking that that's ridiculous, but 9 years later, he's right. So as long as the Fed does that and keeps rates low, and that's why I think their policy of having to raise rates are needed just to prepare for the future, at the very least.
That they have room to move them lower again in an actual, a crisis of a greater magnitude. Is that what you're saying?
Exactly. And not necessarily, it doesn't have to be a greater magnitude either. It's just, they used to make those adjustments when we'd hit a recession, which we're bound to hit at some point, right? Again, and not arguing when it'll happen, just that it will at some point, and they need some kind of traditional stimulus. And I'm saying traditional because all this bond buying that they've been doing since QE started, and then coming back in last year with the pandemic, that's not typical policy.
Right.
So
I think it's one of the things that always causes me to question my expectation that they will raise rates gradually and back to some sort of normal level to allow the economy to kind of function, and interest rates within the economy to function in a more normal way, where it serves as a capital allocation signal to borrowers and lenders, encouraging more lending, or at least more supply of lending potentially in the private sector, but at some level potentially discouraging some level of borrowing as well as rates increase and drive some marginal borrowers out of the math just doesn't work for them at a certain interest rate. Which incidentally, I'll just say as a side note, I think that's actually a good thing. Interest rates driving marginal borrowers out of the borrowing process, because then it allocates capital to only those sorts of projects that have a reasonable expectation of a high return on that invested capital. So, but okay, that's a little bit of a technical thing for some of our listeners others may. I'm sorry for our listeners if you're saying you're scratching your head saying, what did he just say? It's capital allocation is in a free market economy is a very important component of making sure that the economy is healthy and that capital is well used. But on this, the concern that I have in the long run, Roshan, is when we have $29 trillion of national debt, and that's just now at the federal level, on the fiscal side, not, we're not talking about the balance sheet of the Federal Reserve and such. But in this case, when you have that level of indebtedness and you're trying to service that debt, if you get $29 trillion at 1%, just doing the math here, you're spending $290 billion a year on interest, which is about where we are right now. But if you triple that rate, now you're spending $1 trillion almost of interest each year just to service past debt. If you had a 10 trillion or a $20 trillion budget, $1 trillion might not be that problematic. But if you have a $4 trillion budget and you have to layer on to that an extra trillion for debt service, it makes it, I think, in that sense, at least, the political pressure on the Fed to prevent the rate from going too high is intense and will be increasingly so.
And that was the argument that investor made, was that I mentioned around 2012 or so, that stimulus is here forever, was that with all the spending that's out there and all the government debt, you have a cap on how high you can take interest rates before you make the government insolvent.
Yeah, well, absolutely. So we have talked about S&P targets. We've talked about multiples. We've talked about bonds a bit as well, and the interest rates there, and how that'll lead, we believe, to price declines on existing bonds. By the way, listeners, the longer or the more years until a bond matures, the more an interest rate move affects that bond's price. Short duration bonds are less affected by that. And I'll mention another category of bonds that are also some less affected by that, and that's floating rate bonds.
Yep.
So you have floating rate bonds, you have bank loans, which are another category, which also have a floating rate element to them, and other things of that kind. So they're
also inflation adjusted.
Inflation
bonds
adjusted.
as well. Yeah. Add those in. And just as we're throwing ideas in general or areas to research, that was for the bond sector. Looking at stocks, what I'm researching and seeing that areas to look at, some general guidelines. They're looking for companies that have strong profit margins and pricing power. Looking at areas like that are a little more defensive, like healthcare and real estate and energy, things that have not gone up at the same rate at the as the S&P 500 has over the last really year to 3 years. Also looking at financials, just because they typically are set up well when you've got things tied to inflation yields or increasing rates. Banks can charge more in interest. They can make a little bit more money.
Yeah, I believe all those things that you just outlined in terms of sectors, that there's fruitful opportunity there. One, I think healthcare has been trailing somewhat, but especially within healthcare. I'm going to just mention biotechs. Biotechs have been having a really hard time. I think year to date, one of the ETFs that tracks the biotech sector is down somewhere around 20%, at the very same time that the overall market is up almost 30%. So what does that mean? Does that mean get out of biotechs? I look at it as, I'd say, this is not a broad recommendation to everybody. But I'm just looking at for those of you who are in biotechs and are discouraged about them and are ready to bail out, I would say don't bail out. I mean, hey, sit tight just for a little while, and I think the biotechs have a better than even chance of outperforming going forward. There's amazing breakthroughs that are being made in the area of biotechnology, the mapping of the genome several years ago, and the discoveries that are being made as a result of that, and further, gene splicing and gene therapy and so on and so forth. I'm excited about what that sector will be able to do in terms of contributions to human health over the next decade or two. And so anyway, don't bail out is what I'm saying.
Yeah, that's an area where you can look deeper for ideas, right? If you're seeing that it's down so much, digging deeper in that space might be worthwhile. Erik, is there anything on your list that we didn't talk about that you think is really worth? I'll add on one last thing.
Sure.
Is especially we talked about this build back better previously, but
Hmm.
infrastructure may be an area to look into as well.
Yeah, I think there's certainly that, and infrastructure I think actually makes a lot of sense, even on the basis of the bill that's already been passed. The bipartisan infrastructure framework they called it. So there's that. And then in terms of thinking about combating inflation, even though we said we think it's going to be high for a bit and then come back to somewhat more normal levels, what sorts of categories of investment historically have worked well in addressing inflation risk have been things like real estate and commodities.
Yeah.
So even though gold, incidentally, hasn't had a great year, commodities broadly have, and particularly energy commodities in this phase.
Yeah. And the commodity outlook that I was seeing is that it still seems to be in an early stage
Mm,
um, of the I, commodity super cycle is what they're saying. This super
mm-hmm,
cycle's in the early innings is the
mm-hmm,
quote. So
interesting. Mm,
yeah, so it definitely is an area worth looking into.
mm,
Um, we'll be giving updates along the way and throughout the year as well. But I think this is a good list to start as far
mm-hmm,
as what to look for uh,
mm-hmm.
with what's going on with the markets, what's going on with the economy, the Fed, politics. We touched a little bit on each of these areas, and then what you can do about it, where to look uh, for investment opportunities.
Yeah. Hey, Roshan, I just want to say we've been going here for just about an hour, but this is our last recorded episode of 2021.
Yes.
And so we're going to be entering 2022, folks, and looking forward to the year with you. But you're hearing this at the beginning of 2022. And but we just want to say thank you for having been following what we're doing here. Thank you for listening to this podcast. As I hope you perceive, we're doing all that we can to try to provide you with consistent value week after week to do this. But I want to say beyond the podcast, and we certainly hope, and Roshan, I'm sure will say some steps we'd love to ask you to take to promote the show. But we don't often highlight what we do when we're not recording podcasts, which is we serve clients who are looking to solve the complexities and the big decisions that they're trying to face, the highly consequential decisions around finances, investing, how to develop a retirement income strategy, and on and on and on. If you have been listening to the show and finding value in this, but you haven't been working with somebody who you think is addressing these kinds of questions in what I hope you'll agree is a thoughtful and systematic way, we invite you to give us a call. We invite you to pick up, go to our website, retirementlifestyleshow.com, find our contact information, and shoot us an email. What we'll do is we'll set a time to talk with you, learn what it is that's challenging you, and invite you into a conversation about how we might be able to serve as a guide financially for you in the big decisions that you need to make so that you'll have a clear plan of action and can really move forward as successfully as possible into your future.
Yeah, great point. I'm glad you added that, Eric. I'll even add on to that. If you've got questions, the website's a great way to reach out to us with questions. If you've got, they don't necessarily have to be personal questions. They can be topics that you would like for us to cover as well. So please, as Eric said, reach out to us. We are here to help. Please like the show, give us 5 stars, subscribe, tell your friends and family about us. Happy New Year,
Yeah.
since you're hearing this right after the new year. And we'll be back next year with another great episode of the Retirement Lifestyle Show.